Welcome to TheoTrade. This is Don Kaufman. It's December 31st, 2018. It's the final trading day of the year. You know, we still have about 40 minutes to go in this final trading session. But, folks, it's a docile one out there today. The S&Ps are up 9, but it's being done on some rather light volume. To get very specific here inside of the S&P Futures, we're doing, shy of 1 million contracts here. As I said, again, with about 40 minutes left to trade. With that, we'll do a brief kind of 2018 year in review. But more importantly, I've been flooded with emails. What do we think of 2019? Let's get down to it. Obviously, 2018, I think one of the most effective ways to look at it is to start with a year-to-date percentage. That's just a custom setup I have set for you here, and I'm starting with the S&P Futures, which, again, kicking off pretty much in January, whether it's to the upside or the downside. How do you describe 2018? Pretty much Mr. Toad's wild ride of a marketplace, breaking to all-time highs and then falling into what can only be considered some fairly tumultuous volatility. But let's get down to specifics. And to do that, I'm going to cruise over to the spiders, and I'm actually going to close up this left side bar to talk a little bit about, again, markets as a whole, where they're going to end the year. So the spiders, are effectively down right now about 7.3%. Again, give or take 40 minutes left. How does that compare to some of the other major indices? Well, you know what? In an effort to do that, we're actually going to go ahead and we're going to do a quick comparison of the Nasdaq versus the spiders versus the IWM. I happen to have a style built for that. So I cruise over to my styles, come up to my styles, and nevertheless, here we go. QQQ, SPY, IWM, all, again, built in terms of percentages, basis, and all on a year-to-date basis. So again, to get really specific, this is all year-to-date. The QQQ, of course, is the primary symbol right there. All right. Right here in the middle, we have none other than the spiders. And coming in last, the IWM. That's the Russell, people, down about 13%, 7%, and about 3%. Again, conservatively, I'm saying that given the fact that there's still 40 minutes left in a trading session. So most people, all right, you got it, right? The IWM gets absolutely whacked hard. Spiders falls in the middle, the QQQ. All right, so again, kind of, moving forward, what would we anticipate with this? And the answer to that, for me, lies in what I would call convergence. Now, to display a little bit about convergence, we'll have to open up a much broader time frame. In this particular circumstance, I'm going to go ahead and open up a 10-year weekly. All right, because I think the 10-year weekly provides a little bit more, again, kind of perspective on the situation. If you've never seen this before, when it comes down to comparison charting, the comparison always begins with, if you will, a single point, which is like point A. Okay, so all of the comparison starts from this particular point. Now, again, depending upon the time frame, this comparison might look vastly different. Now, when I start talking a little bit about, convergence, and if you guys have never really heard that terminology is predominantly used in what's often, referred to as pairs trading. But a convergence is, pretty simply put, this is the Nasdaq right here. That's the Qs. The Qs will continue to converge upon the other major index products, the IWM and the spiders. So effectively, what are we looking at here moving forward? A continued convergence. Now, a continued convergence, therein lies, the big question is, it's going to have volatility. Why? The only way that we've actually seen convergence over, again, if you study back to any major convergence that's occurred between indices in the marketplace, in any recent history has been done in the midst of what is the extreme in terms of volatility. And of course, we could back up 20, 30 years and even show that to a degree. Nevertheless, I think everybody kind of gets it when I'm talking about convergence. So specifically, that is going to involve the continued hammering of a number of Nasdaq stocks, specifically the market caps, okay, that would really be under a bit of duress. Okay, it's the usual suspects. It's the monsters of what we term technology. It's the Microsofts, it's the Apples, it's the Facebooks, it's the Amazon, it's the Google. Now, to kind of put these into a little bit and take some accountability, in terms of market cap. First of all, Microsoft, it's still going to end the year up about 17%. And the reason that I mention Microsoft first and foremost is because this is where I maintain a bearish position. You want to know why? Because it's up some 17%. So if a continued convergence is going to occur between the Nasdaq and the spiders and the IWM, surely Microsoft is going to take a brunt of that hit. If you cruise down to Apple, all right, Apple's actually going to finish the year down about almost 9%, actually a drag on the S&Ps and the Nasdaq. Facebook, enough said, down almost 30%. Amazon, now, any conversation wouldn't be fun if we didn't throw Amazon's hat in the ring over here. Amazon, and I'll reiterate, this is up some 26%. Now, again, when it comes down to it, Amazon, I don't actually believe that this is going to be the easiest short out there. In fact, in terms of, what I think is going to be last to fall, it would, of course, be Amazon. The point being, though, of course, of looking all this is, people are asking me, are we near a degree of capitulation in the marketplace? And again, absolutely not. And that's strictly my opinion, but absolutely not. And you start looking, again, through different underlyings. Google, down about 3% on the year. But again, let's gain some more perspective than just a year. What does this look like, okay, over the last 5 years? Still up 85%. Okay, what does something like Apple look like over the last 5 years? Still up just shy of 100%. Okay, and again, this is where I say, gain a little perspective. We're about now into the 14th week of some sell side activity. And there's this feeling like, this thing should be over, right? Okay, should it? Should that sell side activity be over? Has anything really, materially changed to what we're going to see in 2019 outside of the Fed? And again, with all due respect, put the Fed aside. Because if the Fed didn't raise rates even once, let's assume they don't even raise rates once, okay, in 2019, okay, they're still on autopilot contracting the balance sheet, okay, which continues to suck capital from the markets. Now, in the shorter duration, obviously you guys kind of get the longer duration, still going to be pressure in the markets out there. And in the shorter duration, there's a few things that I would kind of continue to focus on. One happens to, of course, be the financials. And again, I'm going to throw this into a year-to-date percentage to display to you, okay, the gravity of the situation. The financials are going to end the year down almost 15%, okay? But that's not enough just to throw up the financials and like, all right, they're down some 15%. So we're going to take this even a step further. In effect, what I'm going to do is bring up a style now, okay, that's going to show you everything kind of compared. What's everything? This is sector comparison. I'm going to close up again that left side bar so you get a little bit of feel for it. The big underperformer on the year happened to be none other than XLE. Okay, right behind it to the downside happens to be the financials, right? Energy sector, big dividend payers, okay? Looks absolutely horrible is where I should probably start. It does, looks horrible, okay? In the shorter duration, probably, okay, overdue for a much more substantial bounce. Nevertheless, okay, you have a ton of sectors in here that are probably going to feel the brunt of sell side activity. And again, to throw this into a degree of perspective, it's really important to take a look at what is some of the top performers. Because in effort to create trade ideas in the near term, I'm actually going to look at maintaining a couple of short positions, again, a couple of short positions in some of the top performing sectors, okay? And the possibility of even going out there, okay, and trying to establish minimal longs at this point. The energy sector, and again, I'm pointing to the bottom of the screen because it's the energy sector. The energy sector, again, strictly my opinion, I believe still has to go through a considerable amount of consolidation kind of moving forward. But again, to look at the top of the food chain over here, you've got healthcare. That's XLV, okay? Pretty much one of the top performers. You've got utilities as a top performer. Now, am I ready to short utilities? Absolutely not. The utilities, okay, is being used to a degree as a hedge, okay? Right behind it over here, XLY, it's consumer discretionary. I have shorted it and will continue to look for short opportunities inside of consumer discretionary, okay? And the XLK, which of course is the technology kind of select. So effectively, what we're saying is in terms of, again, sector comparison, I would still consider a large convergence that is going to occur amongst these sectors. Again, and those convergences happen in the midst of what can only be described as the extreme, and that is extreme volatility. Now, as I was saying, again, this happens to be a little bit of a shorter term take. One other kind of shorter term take that I really want to bring you into has a lot to do with volatility, okay? And specifically the volatility futures. All right, for those of you that don't speak volatility futures, listen, the volatility futures are, to me, they're still very worrisome at this point. And I just can't stress this enough as we come into the end of the year, into a new year of trading. It doesn't matter like what's going to happen the first 3 days of the trading year. Who cares? What matters right now is just take a look again at these January volatility futures, which are at 24 against the 44 days, which are 22. I don't care that we rallied a few days, okay? You should just put that out of your head. The volatility futures are still indicating, okay, substantial risk in the next 16 days, even above and beyond the risk in the next 44 days. But wait, there's more, okay? You go out a little further in time, and again, we're looking what often is referred to as contango and backwardation. A little further in time, look at the 44 days are still above the 78 days. Now, if you're not like a numbers geek, I'm a little bit of a numbers geek, you can chart this, okay? Cruise over to charts, go into product depth, I have the curve set up. Effectively what it's saying, this curve, and again, I'll drag my mouse over it, that happens to be the Januaries, this happens to be the Februaries, okay? This happens to be the Marches. What this is referred to as a depth curve, okay? The depth curve is saying January's intense, and things kind of back off, okay? Coming in May, June, August, but effectively, even the Mays, the June, the August, this thing is actually pricing a bit more of duration volatility than we've seen, okay, at any point, all right, since you got to go all the way back into 2011 to see the curve look like this. By the way, for those of you that are geeks, you can actually come into the curve over here, add a curve, and go back in time. I can go back in time. Yes, you can. You can actually explore, like, what did a curve look like back, then. So, yeah, kind of a fun thing to play with the product depth curve. But the volatility futures are a big, big warning sign. And I know, again, a lot of people are looking at the VIX and like, but the VIX dropped. Really? How much did it drop? Okay, we were here. Yeah, but that here, which is 36, that's pretty extreme sell-side activity. I mean, that's Christmas Eve. Everybody's, eggnogging it and barfing up their guts. And all of a sudden, yeah, volatility's come down a little bit. But let's just quantify. We're still at 26. And when you start looking at this for a bit longer period of time, I'll pull up like a 5-year in here. Oh, come on. What's 5 years of volatility amongst friends? In fact, I can even pull up a 10-year. We're starting to make, all right, some marks in terms of the VIX. When I say some marks, here's where we currently are, right here, okay? Cruise a line across the screen over there. Again, we're by far and away at the higher end. In fact, a moment ago, I was just referencing, 2011. Yeah, that's back here, okay? And again, I would assume at this point in time, doesn't look like volatility is about to die down. However, so the volatility futures, okay, remain elevated. The VIX kind of elevated, but there's a bit of a bothersome portion of this, and I'm going to actually show you what's bothersome. The VVIX, like what's that? Okay, it's the VIX of the VIX. It's the volatility of the Volatility Index. What does it mean? Well, it basically tells you how volatile the VIX is going to be. So here's the worrisome part. This is where the VIX of the VIX happens to be, which is, if anything, okay, towards the lower end of the range. So why is that worrisome? Because in effect, and again, my belief on this front, they're going out. They're not buying calls, okay? They're selling calls. So I'll give you a quick lowdown on what I actually think is going on in here. So it looks like trading firms are going out, okay, and buying VX, which is volatility futures, okay, and then selling VIX calls. It's very, very kind of misleading trade, but it's almost like a covered call, right? They're actually buying the underlying VIX, okay, volatility futures, and then selling VIX calls against it. It describes why the VIX of the VIX happens to effectively be down. And again, there are mass number of calls trading in the VIX. Not so much today. Come on, today is docile. But, all right, this is indicative of we're very likely to see another round, again, of some pretty serious volatility. To further that, the skew, that is the out-of-the-money puts versus the out-of-the-money calls. And again, we're looking at like a 10-year weekly, right? Doesn't it seem weird that the out-of-the-money puts, by the way, we're right here right now in terms of skew. Does it seem weird to you that the skew, that is the out-of-the-money puts, okay, versus calls, those puts are trading for what? On the lower end of the spectrum, okay? So it looks like we have some premium sellers. And again, it makes me a little nervous, and I'm using this almost as like a contrarian. It makes me a little nervous when there's so much premium selling going on in the midst